Financial modeling and valuation analysis. We will be looking deep into financial model development. We will be looking deep into valuation analysis. We not only look, but we will be working side by side. We would be developing many financial models. We would be looking toward financial analysis. We would be looking toward the discounted cash flows and many more things. First of all, let me introduce myself about you to you. I am your trainer. My name is Daniel Ali and I am a qualified finance professional. My qualification include chartered accountancy part qualified as I have passed the two levels of a CA. I am ACCA finalist as well. I am associate certified financial and management advisor as well. I hold an advanced certificate in internal auditing, certificate in management accounting. Just wait for a second. I just enter another one. Yep, I'm just back. So I am a candidate of CMA USA Certified Management Accountant Part 2 exam. I hold a membership of Institute of Financial Accountant UK as well and Institute of Public Accountant Australia. I am Certified Financial Modeler UK. I hold further certifications such as Advanced Financial Modeling and the LinkedIn Learning Financial Analyst. Along with my professional qualification and certifications, I am SAP Business One consultant. Currently, I'm working as a remote finance manager, or you can say financial planning analysis manager in a UAE based firm. I am also teaching finance subjects in University of Lahore as well to the accountancy and the finance students as well. There I also train the students bachelors as well as the masters in financial modeling. Currently we're gonna start the SAP as well. That would be the technical as well as the functional consultancy level as well. We would be looking towards the financial module as well as the controlling module of a SAP. Complete level training, consultant level training would be starting in summer days. If we look forwardly, we're going to launch some further courses with a collaboration with the University of Lahore as well for all the finance professionals as well as the university students. I hope you understand very well about your trainer. So, how would your course move on? It would be working dynamically. We both be interacting ourselves and we would be looking many things. Let me type some content on a chat box for you. Till now, if you have any question, you can ask me. So, our financial modeling course would be starting from fundamentals of financial, you can say modeling or accounting. Then we're gonna move after fundamental level. We're gonna move toward financial planning and analysis, looking further deeply into operational modeling. So, what is an operational modeling? I'm gonna explain you in just minutes. After operational modeling, the very important thing, the three statement modeling building, we're going to start working on it. We're going to look toward the driver based approaches to calculate the financials, and nextly we're going to look towards the corporate finance model development, and this way we're going to look towards, we want to look toward DCF modeling. You can say the discounted cash flow modeling, free cash flows modeling, and is the valuation analysis. We're going to look toward the business analysis, and then more deeply working, we're going to look towards our further advanced equity valuations. Equity valuations from a balance sheet approach as well as from an income statement approach. There are two different approaches to calculate an equity valuations. This is your main subject to topic which you're gonna learn here as well. Furtherly, if I look towards some fundamentals, as you know, into your IS1, you have a set of financial statements available. It consists of five statements. First of all, you have a statement of financial position, which you say is the balance sheet. If you look forwardly, you have a statement of financial performance or P&L statement, profit and loss statement, or you say statement of comprehensive income. If you look towards thirdly, you have a statement of changes in equity, in which you look towards the equity movement. If you further deeply down, you have some cash flow movements and that you call cash flow statements. And not least thing, lastly, you look toward the notes or schedules or the working. All these statements are being prepared in your financial model. Just wait for a 1 to 2 minute and you would be looking deeply into the financial model being prepared. And in the live session, you would be working with me to prepare the financial models. These are the statements which are being discussed in IS1. You have an international accounting standard. It is called a presentation of financial statements. Now IS1 is being changing towards the IFRS 18. I hope you understand the IFRS 18 and how the things are going to be shifting or move. Only the classifications of some line items have been changing. The next thing, it says what is financial model. As a financial statement, financial model is very similar. You can say it's a duplicate of a financial statement, but it only consists of three main things. You have a financial positions, you have financial performance or a profit and loss statement, you look toward the cash flow developments, and you have schedules or the notes. What is your changes in equity? Your equity statement has been shifted towards your schedules, annexures, or the notes development. I hope you understand these workings, these understanding, and then we're gonna move forwardly. If you have any questions, you can ask me. Just wait for a second. There is an Azan break. The next thing, very importantly, you need to understand the relationships between the three statement models. How you develop the three statement. It's just a mystery for you till now, but as you move a step by step, your mystery would be solved. You will be looking the development of a three statements. As I told you, you have an income statement, then you have a balance sheet, and thirdly, you look towards the cash flow statement. Let me highlight it for you. It's being bold for you, and side by side, you would be learning some shortcut keys as well. Control B for bolding your statements. What's the next? It says for a financial analysis, and your business valuations, you need these three statements. Yes, we agree, we need these three statements. These are interconnected and they provide a comprehensive view of a company financial health. Don't worry, let us look toward the statement, toward the financial model. Here you go, the financial model available in front of you. It starts from an assumption as you have been looking towards a complete financial model case study. In this course, you're going to develop a case study on a financial model. You're going to look many things deeply and you would be practicing by yourself along with my help. I am available for you. At first, you have an assumption, but this is an input thing. This is not a essential thing. Next thing, you look toward the statement of profit and loss. If you see, you have revenues starting from a year 2015 to the 2019, and at the top, you look, it's an historical data. This means that company has provided you earlier information. Here, at the below, you have an historical information, and you got to see 5 year historical information starting from the year 2015 towards the year 2019. My revenues, cost, gross profits, the first subtotal, then you got an expenses list, and you got EBTs, earning before taxes, the third subtotal, you got a net earnings. By the way, this is a statement which your company provides you. And as a financial modeler, as a financial consultant, you prepared a very well developed model and a statement available in front of you. See how well it is presented, starting from your revenues towards your gross profit and your expenses details, your operating expenses. Then it look towards your EBITDA, or you call it profit before interest, tax, depreciation, and amortization. You have some depreciations, you look toward the profit before interest and taxes, you have some interest expenses, profit before taxes, you looked into deeply the net incomes. I hope this is a financial position or financial performance statement which you early worked, which you early understand in your study or wherever you read it. You have some years starting from 2015 to the 2019 and moving forwardly 2020 towards the 2024, you have a forecasted data. So you projected your things, you forecasted your things, and these things have been developed with the help of assumptions, with the help of discussions with the management. Your management decides, your management provides you information, and that information is very helpful, very useful for developing financial model. As it states, these are the three statements. First of all, you have a statement of profit and loss. Then you see statement of financial positions, discussing your assets, discussing your liabilities, your equities. Your equity include retained earnings, your capitals. You can further accumulate your capital. You can further divide your capital into share capital, share premium, or many more types of capital. By the way, in just minutes, we're gonna learn, we're gonna understand the types of an statements as well, types of an equity, types of an assets, type of a debt, or the short term, long term, whatever the requirement is. The third statement you look is your cash flow development. Here, your cash flow starts from an operating cash flows, the very first statement. Then you look towards second statement and second part, it's an investing cash flows. The third thing is the financing cash flows. You have some subtotals. You have some subtotals. The first one, cash from operating activities, very much needed. This is needed for your free cash flow determination as well. Some further valuations as well. This can be needed. This is very important to see your EBITDA and your CFO, or you can say cash from operating COA activities. Your investing cash flows is being directly related towards your balance sheet. You look towards your investments in business. What business investments? You look towards an asset investments, asset disposal cost, or whatever you purchases. You have some things. Operating cash flows have been starting from your net earnings, it being a part of your income statement. If you see upwards, you have an income statement, and here your income statement, net income, or our profit after tax that has been linked towards your cash flow thing. If I click F2 key, it says it has been linked with the cell age 31. And if you look upwards where your age 31 is, it's been linked towards your net income statement. This is how your financial model is being developed and dynamically made. Next, you judge some non-cash items. You look toward working capital. You have some sporting schedules. So these are the annexures. These are the sporting schedules. These are the notes. You can say the workings which are essential, needed for the development. You have some depreciation expenses. You look toward the property, plant, equipment development. You have some loan development, calculating of interest using some Excel formulas. You have an average Excel formula working. See here from 2020, you have an average working which relates toward your interest expense amount, interest rate. It is being developed. You have equity schedule development. You looked into the retained earnings, capital, working capital amounts, working capital changes, and the net working capital. All these are very important. Cash conversion cycle is very important for your cash flow movement or a cash movement. These are the three statements. Now let us understand how these statements are linked. By the way, I have just given you an overview that your net income is being linked towards your cash from operating activities. It's being a bottom part of your profit and loss statement. If I look towards the financial position, my assets, my very first asset, current asset, it's being a cash, and that cash is being linked toward my closing cash balance in my cash flow statement. I calculated my cash flow statement closing balances each year, and that is linked towards the upward. If you see towards the amount for 2020, that is 572 for 2025, and here I go upward. My balance sheet, it relates 572 425. You got an accurate result. This is how your model should be workable and it should be dynamic. Very first thing, it says your income statement relations with the balance sheet, how these things gonna be linking. My bottom line, my income statement bottom. I have a net income that goes in my balance sheet as a part of an equity. Which equity portion? My retained earnings. Let us look toward the retained earning working. Here I have a retained earning schedule. It goes towards my opening retained earning balance, then my current year net income or a profit after tax if there are some dividends that have been linked here, and then I got my closing retained earning balance. These closing retained earning balances are being linked from a working, from my schedules, from my annexures towards my upward equity portion. If I show you my equity in my balance sheet, here you got a retained earning. All these have been linked toward the downward cells. If I click in any cell of 2020, it shows the linkage H118. Let me see what is the H118 cell that has been discussed upward. Here I got my closing balance. Now you see how the things have been working and how the things have been relating. My depreciation and amortization. Yes, these are some non-cash expenses which are added back towards the cash CFO balance. I have some income statement values, depreciations, which reduces the net income as well. And similarly, As a matching concept, my income statement decreases, my asset value decreases over the time. Over the time, I'm gonna look, I'm gonna prepare. It's being a depreciation and amortization. It's being a part of my PPE, property planning equipment. If I show you, here I got a property planning equipment schedule. My opening property planning equipment, I have an addition of a capex. Capex means capital expenditures, which company is gonna purchase some assets. I have some disposals, my depreciations, though in WDV method, in a written down method, you have depreciations already being net off of your opening balance to get a closing balance. I hope till now you understand. If you have any question, you can ask me. Let me look towards my chat box. So I want to review that how my session is moving on, as it's being around 30 minutes gonna be moved. How my session is moving. I just need a quick feedback. I hope you all are working very well and aligned with me. By the way, depreciation are again being the part as an income statement that relates towards my working in my cash flow statement. Until now, everything is going well. Very thank you, Mr. Wasim. My balance sheet and the cash flow relationship. First of all, if I look towards my working capital changes, now you should look towards your current ratio, that my current assets ratios my current liability. So all these are being the part of a company, and these are essential positions, these are essential line items. Here I have my working capital schedule at the end being prepared. It relates my account receivable. If I'm furtherly deeply working for you, alt HIR, you have a thing for a shortcut key, Alt from your keyboard, H to open the home tab. If you want to insert a row, I press and it say what you need to add. I need to add a rows, and then selecting that my row has been selected. It's just your practice which makes you perfect. Then my account receivables and inventory account payables. Let me make my heading very comfortable for you. Current assets or HIR. Until account payable, I need an addition balance of my current asset balance. You can say current asset without cash as well. If you want further deeply, current assets, my 2015 current asset are 218652. If I want to move my formula forwardly, I have some shortcut keys, shift and the right arrow for my keyboard, and then similarly control R, which relates all my workings. My formula is being copied towards the next cell, and that saves my time. Being a financial modeler, financial analyst, you need to save the time. Shift and the downward right arrow key which selects all your input data. All H B, I need to add my border which should be outside stated related my workings. Current assets, alt HIR, account payable are my balances. current liability balance, which include only account payable, as company has some short-term loans or you can say borrowings towards development of an account payables. My net working balance and that relates towards my changes in the working capital, cash conversion cycle development as well. My long-term asset purchases, yes, my long-term asset purchases are being the part of an asset from my balance sheet value, and then I look towards my cash flow thing, which stays toward cash flow from investing activities. My debt and equity transactions are being moving. Debt are being the part of my balance sheet liability portion, and then if I increase debt during the year, if my lenders gave me more debt, if my lenders return my debt, if they don't return anything, they would be the part of my balance sheet, not the cash flow. The transaction during the year is called cash flow from financing activities. I hope you understand. Now I'll see at the below your income statement relations with your cash flow. It firstly states your interest and dividend payments are being stated along with my income statement, and those gonna be related towards further development. Those gonna be related towards the further workings. I'll go back toward my operating cash flows. My operating cash flows are being the very important part of a company cash flow statement. As you know, that cash flow statement can be prepared in the two different ways, your direct way and the indirect way, while indirect way is more comprehensive than your direct method. My closing cash balance moves towards my balance sheet, and that we call a closing loop. Cash and cash equivalent balances, the closing cash balance and a cash equivalent from a cash flow statement, it becomes the opening balance for next year or a coming year. What is the cumulative impact? If I explain you that the sum of a cash flow from operating, investing, and financing activities changes in a cash position during the year is called my cumulative impact. Means in my easy language your cumulative interest or your cumulative impact is just a double entry system. Just read the below slide and ask me if you have any question. I'm just waiting for your question to be answered. Hi Dhanasar, this is my way. I believe all participants understand Urdu and Hindi. If you may ask all of them if they're comfortable with Urdu language. So I'll be asking you furtherly that if you have any language barrier, you can say me English or in Urdu, whatever you think required. I just started from the English because many understand in English easily, while I am using an easy English language. If you have any questions, you can further ask me. My investing, financing, and operating cash flows are being moved, are being clubbed together to get a closing cash balance. My financial position and operation, my financial position and the income statement have very direct relation and a very further. Here is a financial model schema available into you in front of you. It says you need some inputs, that outputs, some processing. How would you work on your Excel? So first of all, I need to keep my space empty for the dashboard development, for the scenario development, and at the third sheet, you develop your revenue schedule. Your cost drivers gonna prepare for you. See, your output result is a financial model which includes the three statements majorly your income statement, your balance sheet, and your cash flows. I relate those. Now, what's the next thing? You need to see some further workings. Here is a common approach towards the financial model structuring. You need to structure the financial model according to the approaches you have been provided, you have been discussed, that your financial model should include the three statements. Very importantly, those statements can be presented in a way that you have an historical, or you can say the vertical approach, including your horizontal values as well. And if you further see, you have a separate horizontal view of your gift. Horizontal includes each sheet, each tab working. I'll be showing you, and your vertical shows that statement is being developed in a single sheet. You have a hybrid tab option available as well. You prepare a such way financial model which looks like an horizontal but is furtherly working on its historical way, or you can say the row wise result. You need to understand the key drivers as well. Here you have an income statement. You need to understand the income statement and give me some answers. Till then, I'm gonna move forwardly. I hope you understand these things. I'm just taking second breaks. You read and understand these things, and then we're gonna move forwardly. I hope till now you are learning the statement, you are learning the things very deeply. You have another type of income statement includes the year as well, and it further will look towards scholarship development as well. Here you got to see analyze of an income statement. Till now, if you have any question, you can ask me. Just wait for few. Just a break of 5 minutes, and then we're gonna resume the session. What are your understandings and key findings of an income statement and its analysis? Type on a chat box, and then I would be reading it. Just a 5 minute break from me. I hope you have watched it and you looked understandable that how the things gonna be moved. Yes, Mr. Bilal, uh, if you have been registered, if you paid the fees and you have been registered, you will be getting the slides as well as some working. I think some practical work must be started within the session. Yes, Mr. Mayor, I will be starting some practical work. Let me just go back and make some brief introduction of financial statements. All the registered participants will be getting an access of Google Classroom. There you would be getting the recording of a financial statement, this lecture, and afterwards you wanna be looking some files, some extra guidance with me where we all be communicating. You will be added into the WhatsApp group as well. The work would be answerable. So, I reply you again of your question that we will be working practically as our session is healthy. It would be 2 hours dynamic interactive session. We will be working practically, but before moving practical side, I just need to introduce the financial statements, the income statement, balance sheet, and the cash flows. As I told you, the relationship part, how the three statements are being linked. But afterwards, I'm gonna teach you how the three statements have been developed, the line items, and then we're gonna start some practical work as I am side by side guiding you the shortcut keys of an Excel as well. You need to understand these things. And the recordings, the files I'm again telling you that would be shared to all the registered participants on a Google Classroom. Thank you very much if you understand your point of view. So I hope you understand how the income statement have been analyzed in this way. You got towards the revenues, revenue growth as well. You have a cost of goods sold, your gross profit margins, your operating expenses. If you look furtherly, EBITDA growth, EBITDA margin, your EBIT, and similar way, I am going down towards my net income to the EBIT ratio. I hope you understand these things, and these are some financial KPIs. Let a brief case of what we learned about our working. We learned about some approaches, that a vertical approach and a horizontal approach. I showed you the horizontal approach where on a single sheet all my financial model including my income statement, my balance sheet, my cash flow statement, my supporting schedules, and if I look upwards, my assumptions have been linked on a single sheet. See here toward the second sheet, it's a scenario analysis. It's a different kind of thing for you to be understandable. And here's some horizontal approach. If I show you a horizontal approach, here you got a horizontal approach. I got it and I'll be showing it. You have a summary which you got to see some important KPIs, the key developments, and the next thing you got an assumptions where you relate some key inputs, how the inputs have been developed, the management discuss the input for you, the depreciation input, your lining, your key item inputs, your income statement input मैं कर देता हूँ. Your income statement input, your balance sheet inputs, and some further developments. Remember, now we are understanding the horizontal approach. Next, the scenario development. I got my revenue schedule. So see, understand that in horizontal approach, each sheet has been developed, each line item is being separately showed, separately mentioned for you. This is a very perfect example of driver-based approach, driver-based learning, driver-based planning, driver-based modeling. So each driver means your line item, your key important element, KIE, or you can say key performance indicator. So I am looking towards my revenue growth. Here I got my revenue. I got my net revenue, and how can I find out revenue growth? Don't worry, in just a second, you're gonna learn the revenue growth equals to opening parenthesis, shift and 9 to start a bracket, selecting your current year revenue minus your last year revenue, closing parenthesis, and here you got a change in revenue. So my revenue increases $23.1 than my previous revenue. You need to understand this. Divided by my last year revenue to get a balance. Here you got a percentage, shift right control R, and you got a balance. Changing it towards the percentage, you got a growth. If I see towards a single decimal place, you got a growth in a revenue. Revenue growth. See, in a year 2020, these are actual figures. As you see, 2019, 2020, 2021 are the actual things and how the things gonna be moving. 10.8% your revenue grows from a previous year, and similarly it increases towards a thing, but it's an alarming situation that it decreases significant percentage. If I zoom in for you, that your year 2021 it's being 13.4% decreased, then certain increase into 2020 2022, and it being forecasted or projected towards 23.3%. You can see a COVID, post COVID result as well. And as it's a manufacturing company, you can consider that it's being a, you can say the medicines manufacturing or whatever the thing it relates toward. If I go quick analysis, control plus Q, you have an option, spark lines, column or a line chart. Here you can see win or loss, it shows you the thing, how the things have been relating, and how you got to see the thing movement. Downward movement on a red bar moving downward shows you the downward trends, and a blue shows you the upward trends. See, in a year 2025, you have a 0% growth in your net revenue. If I go back towards my revenue development, how my revenue is being developed, you need to see the things going toward my scenarios. See, my sales prices has some inflation factor added. My sales volume has some inflation factor added. See, very nominal thing, 5%, 4%, 3%. All of these things have been incorporated in my model to drive my revenue. Similar way, it goes for my cost per unit development, and my total cost. My total cost includes variable cost, my raw materials, utilities, moving towards my fixed cost. That should be the very important part of my total cost. As you remember in IS2, per type here, IS2, you have your inventory accounting standard, which relates some working. You have a manufacturing account details, which explain some further things that manufacturing accounts explains you about the prime cost. It explains you about the direct material cost, my direct labor cost. If you see here, you have it being operated as a fixed cost. Then I furtherly move towards the raw material consumptions or a consumed, then laterally cost of goods manufactured. I move downwards and getting an ending point of a cost of goods sold. In this way, we look toward the work in process goods. Similarly, we look toward the finished goods cost, and if the cost is not available, we have some NRVs. My cost, my NRVs, these two are being related. Here I have my financial statements. See, in an horizontal way, my financial statements are being linked separately. These are being developed in a single sheet, and you see your income statement key driver margins. Very importantly, you have some cash flows, you have some balance sheet, while my depreciation separately calculated. This is being the waterfall chart for you. You have some text calculations, working capital. See how detailed your working capital has been explained you. We're gonna develop all these things in our live session. This was a horizontal approach, the vertical approach, and then we have an hybrid approach. See, on a hybrid approach, you have an option that you can prepare all schedules vertically on a one sheet, and then you're gonna look these things very deeply. Your financials should be developed separately, or you can develop financials on a vertical way to make it a hybrid model. You analyze your income statement. Here you have a second income statement to be analyzed. A Charlie company, three segments. You have a Lahore, Faisalabad, and Karachi revenues. You look toward the total revenue, gross profit, and see how important, how growthful, and how informative this financial statement is. Add up below, you look toward the net operating profit after taxes that relates toward your net operating profit after tax margin. Here you got to see analysis of your balance sheet. How you analyze your balance sheet that has been explained here as well. You have some very important three parts of balance sheet analysis. First of all, you analyze your balance sheet according to your liquidities. You analyze your balance sheet according to solvency and the financial stability. How these things develop. These things are very important for your financial analysis and the company financial development, financial projections, financial improvements. You need to analyze the balance. Onto the liquidity position. Some further development ratios. You look your current ratio development and your quick ratio. By the way, you very deeply look towards the cash position movement. Your current ratio includes your cash, your quick ratio includes your cash, not the inventory. All these are some short-term things that helps you to assess the liquidity. Then you look towards some solvency evaluations, your company debt valuation, your company equity valuation. See here, I have been discussed the debt to equity ratio. This is very important if you work for a company, if you look toward merger and acquisition, if you look toward the consolidation things, the debt to equity ratio is very important for the solvency development. If I look my financial stability, development, my equity development, cash development is structured, whether the company is consolidating, whether the company is being acquiring by another company, whether the company is merging with another company. You need to understand these things. You need to understand modes and how these things gonna relate toward the company financial stability. You need to understand that. Financial model is basically developed to understand the financial position, financial health of a company. Is an estimate. I again tell you that it is an estimate 99.9%, but it's not 100% accurate. You need to understand these things. If you have any question, you can ask me. Your balance sheet is being further divided, further analyzed for your working capital. We already looked at that my working capital should be efficient, it should be effective. The management should look toward the development. Management should make daily goals for operations. Management should look toward the daily goal for the workings. As it sports that my account payables, account receivables, and inventory are the major portion of my working capital. You need to understand. Now let's look an interesting case in front of you. Let's say the manufacturing company has some prepayments, have some other assets, have some other liabilities which are related towards your thinking. Now, as you think these things, these should be proportionate towards your asset, towards your further workings. If I look toward prepaid expenses forecasting, how these expenses should be forecast, if I click, see, my prepaid expenses should be the part of my cost of sales. I'm just moving slowly for you here. That my prepaid expenses are being the part of a development of a cost of sales. If I look towards my account receivable balance, this is the part of my net revenues. My current assets are also the part of my further development of a cost of sales. So it's being a specific percentage of a cost of sales. Changes in working capital development. I hope you understand how your working capital moves in. Your balance sheet is being analyzed by your investors from your stakeholders. So, first of all, understand that there are some internal stakeholders. Then you have some external stakeholders. Internal stakeholder is your management. If you deeply look, you have a strategic management level. Those are very efficiently needed of your internal resources. Then your external stakeholder includes shareholders. Nextly, you have some government authorities, some debt lenders. You can say the banks, assets, purchaser or receiver, whatever you see, those are some external stakeholders of an organization who analyze the balance sheet. You need to understand this thing. Now you see the balance sheet analysis. You analyze your income statement, you incorporate your income statement in your balance sheet as your revenue is a part of trade receivables. You take it, you see it. You got to see revenue growth. Next, your cost of sales. As you see, your costs are being the part of a purchases. Those relate to your short-term liabilities that are trade payables. Similarly, gross profit. No, you're selling general and admin expenses. Some of those are to be accrued and some of them are to be prepayments. You have an EBITDA adjustments, EBITDA movements. Thus, EBITDA relates toward your cash. As I already told you that your cash flow statement starts from a net earnings, then you add back non-cash item. If you don't add back a non-cash item, don't look towards your net income. You got to see EBITDA calculations. Your depreciations, non-current assets, profit after tax relates toward your retained earnings. Here you got a ending point. Your taxes toward further segregation into deferred tax, current tax. I hope you understand this very well. If you have any question, you can ask me. I'm looking toward the chat box. Till now, if you have any questions, you can ask me. We have still an hour left for our working for an understanding and how you like my session. You can type it. It will be giving me motivation for my further hour working. I'm just waiting for your reviews. I think that you all are just busy in some kind, and session is great, but you are moving a bit fast, so it's a bit difficult to cope it. Mr. Mayor, I just move fast in some points that I thought that it is a very basic point as analysis of balance sheet. I knew that that would be a basic or part, but very informative. Don't worry, in our live session, we're gonna cover all of these workings. We have a case studies available. I have 10 to 15, or you can say multiple case studies in my mind as well as in an Excel, in a Word file, which would be shared to you as well, which relates your income statement forecasting. Then the three statement forecasting you relate towards an free cash flow developments as well. If I show you another thing, see here, I have a profit and loss statement. This case study is very important. It explains you some of things. It includes some projections, some working. All right, we understand that. Now look here. You have a non-current asset schedule development. Further, first you develop investment properties. Then you develop your plants. Thus, it is also an investment property, your warehouse investment property, then property plant equipment. Your warehouse was being transferred from an investment property towards your PP. Change in classification, change in asset, all has been worked here. Now you see how informative. By the way, this case study is being the part of my operational modeling module. It includes an understanding of an IS 16, IFRS 16, then IS 40, IS 20, IS 23, and some further developments. You need to understand these things and how the things gonna relate. In just a live session, I will be tutoring you the accounting standards for the case study which are being added into the operational modeling that are very important for the development. Though this thing doesn't include my lease, my this thing doesn't include the lease, but the case study which you would be getting, that will be included a lease proportion as well. IFRS 16. See here my revenue schedule. Now you see the driver based approach. Let me certain zoom in for you. My revenues of a product 1, product 2 revenues, then my cost schedules of a different products, and these are being related. Linking my values from here towards my profit and loss statement, and it got to see my gross profit. See, if I click here, it says revenue cost schedule sheet. That has my third sheet. If I look toward the first sheet, how these things are be related. This is the case study which you will be solving. Here you got some cash flows issues which are very important for the understanding how you relate your cash flows. Very first issue. Some of the financial modelers, some of the financial analysts, some of the accountants, the ERP consultants, they neglect the non-cash items. See, there is a list of a non-cash item. You have an impairment loss. You have an interest expense, a non-cash item. or a finance cost, a non-cash item. Next thing, you have depreciations, amortization, impairment loss, then some further gains or loss on a disposals. All these things are non-cash items. These are the issue. The company may not adjust accurately, or company accurately adjust with a inaccurate view of values. I explain you, in a case that you have a depreciation of a $10, but you record depreciation as a $25. Then at the back end, you are reducing your net income after tax. And in the cash flow statement, if you add back that thing, that would be grating, that would be overvaluing your net income. That is also an audit issue. That's why the prospective financial statements are also called forecasted financial statements. These are also being audited. Remember, the participants in an audit, in an advanced audit and assurance workings, in your external auditings, you have an audit standard that permits you to audit, permits you to read, permits you to expand to understand the financial model, the forecasted financial model. There is an issue as well as the solution of a non-cash item. It says ensure that non-cash items are appropriately adjusted to reflect their impact. So, very first thing, a solution from me, that you should be segregate duties for a cash flow development. You should need a 2 to 3 at least person who would be specialized in a forecasting, who would be specialized in an accounting, and who would be specialized in a reading financial statements. Thus, 3 person relates, and then their non-cash item negation would be decreased certain percentage. I hope you understand this. If I look forwardly, overlooking working capital changes. Now, as I explained you, your working capital include receivable, payables, inventories. It values have a significant impact on cash flow from operating activities, as well as significant impact on the closing cash balance. So you need to understand the development of working capital very accurately. See, I have my working capital. If I change certain value of a cost of sale, then its value should be furtherly changed. Your inputs should be accurately added into your model to get an output. What is an output? This changes in working capital. This is a basic output. This is an ultimate output of your part. This should be recorded very accurately for you. I have some inconsistent accounting policies. This is not an issue by an accountant. This is not an issue by a finance professional. This is not an issue by your finance manager. This is an issue of a company. Why they choose inconsistent accounting policies. Last year, revenue was recognizing by 12 months. Now, revenue will be recognizing by 10 months. They are considering certain percentage for the 2 months. That is wrong policy. You need to understand the company policy first, and if you have any questions, queries, you can relate those to your respective authority, respective supervisor for your working. What is an issue? If I relate you, it says inconsistencies in accounting policies, especially changes in a treatment of certain transactions, can lead to misinterpretation. Yes, if you have an IFRS consultant, if you are IFRS developer, then these things are very important to understand. Certain transactions needed to be made up for you. Certain transactions are being available for the development. You need to understand these things. If you have any question, you can ask me. So, Mr. Umair, you say that I am giving you a bookish knowledge. All right, I understand that. But to start from a basic, there should be a bookish knowledge. I hope you understand that. If I give you now, just wait for a second, I'll show you a thing. See here, the depreciation working. I will not disclose the company name, but see, they are they are working on a WDV method. Then they want yearly forecasting values. I hope you understand that the company look towards deeply into the yearly things. But as a finance department, as a finance professional, you need to see the actual development. Actual comes from monthly things. Now, company made July and August actual payments, actually movement, and then from September to June 2025, they asked that to forecast for a 10-month. All right, we agreed. Here are the assets of a company. They have the land. Land is not being depreciated. I hope you understand this. Next thing, you have a buildings, vehicles, plant and machinery, electrical installation. Now, question your manager that why electrical installation are being depreciated. You have some factory equipment, PPE part, office equipment, PPE part. Now, as they already calculated the 2 month depreciation here are being depreciated, then they don't provided you any value for the 2 months thing. What will you do? How would you calculate if you don't have any knowledge of a basic things? How would you prepare the depreciation schedule? Now, you prepare depreciations that your depreciation for the 2 months are being actual and remaining are being 10 months forecasted towards furtherly working. Now, see, land is being depreciated yearly on a 10%. All right, we agree. But to move in a monthly basis, we need to make my depreciation rate into monthly as well. Divide by 12. Then calculate each month depreciation, relate it towards some working. Your closing book value of a last month would be depreciated, would be allowable for depreciation for the current year, current month. This is the WDV working. Then you calculate each asset working, each asset depreciation. You allocate that depreciation into respective percentage, that how much percent your depreciation would go towards your cost of sales, would go towards your admin working, would go towards your selling, and total depreciation is 100%. We know that. You took some old practices, old workings, that your depreciation was three thing dependent: cost, admin, selling. Divide those. Then each month depreciation is being converted into monthly cost, monthly admin, monthly selling to get the values. This is the practical work. But how do I teach you or train you on a practical work on a very first day? If you have any further question, you can ask me. This is a Pakistani company. I am not going to relate a name of it, not going to tell you the name, but I hope you understand that in the first session, no one explains you the practical thing. If you have any question, you can ask me. I am waiting for a question from all of you. You have some timing difference in a revenue recognition. That's why your movement, that's why your cash movement is very distorted and your cash flow would be irritated. You have some financing cost issue. Financing cost is a very important KPI, very important key element. You need to understand that the company which I showed you the depreciation schedule, they are being wasting hundred thousands of money onto the financing. If company current ratio is not proper as per requirement, they need to understand the working where there is an error. They need to look towards an ERP development team that why values are not being accurately. That's why I explain you inaccurate accounting policies. That's why I explain you that companies sometimes recognize revenue differently. There is timing difference, and that makes a difference, that makes your error in a calculations. But remember that your forecasting, remember that your financial forecasting financial model is just an estimate. It's not an actual result. Your actual financials are being different from your forecasting. Don't you think that you prepared and forecasted financial model, and that would be answer, that would be final statement from you? How can we overcome this time difference? Yes, for the timing difference, please allocate specific days. See here, just wait for a second. See here, your company operates 365 days, all right. Now, your company allocates 45 days to your account receivable. They allocates 70 days, around 60 days, 65 days towards your inventory. These are the timing ways. How do you recognize your revenue? And if you furtherly look towards your five-step model development in your IFRS 15, they deeply explains you how you recognize your revenue according to time, point of view time, or the other adjustments. There are further two developments in IFRS 15 that explains you the revenue recognition points as well. In your financial modeling, your accounting knowledge is very much needed. You misinterpreted your positive and negative cash flows, which relates some very much error. Your cash position would be distorted, your cash position would be not accurately forecasted. What is the solution? It says it provides a clear explanation of a meaning and significance of positive and a negative. You need to understand first of all nature of a business. Next, you need to understand how your business is moving upward or downward, and that is being related towards you. If you exclude some important cash flow components, your cash flow statement wouldn't be completed. That would be incomplete statement, and you need to see things. That is why I showed here the dividends in your cash flow statement. See here just the way I showed a dividend in a retained earning. Dividend payments. Company was not paying dividend from the last year. They changed the pattern in a 2021 to pay a dividend. That should be recorded. Each line item should be recorded and being explained. You and it should also be explained toward the internal as well as the external stakeholder for the explanation. You need to consider seasonal variations. If you are a manufacturing, if you're a fruit company, then you need to see seasonal variation. Your revenue recognition pattern would be changing, and according to your matching principle, your expense will also be related. I hope you understand. Very lastly thing, very greatly thing, that your financial model should be dynamic. It should be very much informative, that everyone can understand your financial model. It should be very important that it should be adaptable towards the market consumers, your behavior, your purchasing patterns. All of these things gonna be needed very much. Our dynamic financial model can adapt toward the changing. That's why. You see, if I change my scenario, currently your revenue is being recognizing at a 12.5%, 12.50%. If I change, now it's being recognized as a 10.5%, and similar way your revenue changes. Now you see 10.5%, and I got my revenue. It's being 1.1 million in a year 2021. If I change my revenue 8.5%. Now you see my revenue further decreases towards 1.107 million. I hope you understand that it should be dynamic. Each key element should be workable. Your scenario planning should be very effectively. Here you got to see scenario development. Here you develop scenario analysis of each line item as well as all the balance sheet items as well, which are very powerful, which are very importantly to be changeable. Those need to be teach here, those need to be trained here. Investor confidence. For your external stakeholders, you need to prepare the actual financial statements. You need to prepare your projected, your forecasted or prospective financial statements. Those are very important for the business development, for the business future growth, for the working. Those are very important. You need to understand the things and how the things gonna relate it. Financial model development, it very importantly helps you for the development of your decision making. It improves your decisions, it improves some workings, and how these working relates. You need to understand things. Real time updation, yes, your model should be updated each time. Your financial modeler shouldn't waste time while preparing a financial model. It should make a relatively easy understandable financial model. Operational efficiency, as a business is growing, it should be increasing some further business segments. IFRS 8 workings, your segment reporting, your segment development should be very easily incorporated in your financial model, and thus you need to understand that. You should allocate resource according to percentage. That why that is told you that I allocate my 87% around depreciation to the cost of sale. You need to allocate your resources. Next, my admin include 9.1% of depreciations. My selling include 3.2% of depreciation. You need to understand these things. Allocation of resources, how these things have been allocated. You should compliance with the management. You should compliance, you should communicate your reports with the management. You should communicate your reports with external as well as the internal stakeholders. Your financial information should be concisely informative, should add a summary point, and should convince, should add some things for the development of a future. It should help you to improve the things. What is an Excel DADA firm? Framework? It explains about the dynamic, flexible. Then your Excel model should include accurate values. It should be digestible. Digestible means understandable. It should be attractive. Yes, it should be understandable as well as very good looking, attractive to make interest in the stakeholder mind. I just show you. Now you see the first type of financial model. You have a profit and loss statement, very good presentable, balance sheet presentable, cash flow statement presentable. The investor would be very good mood to see a presentable information and giving you investments. Next thing, see here, presentation. You need to present your things, balance sheet, cash flows, income statement. A very great presentation should be added, a very great color handling techniques, data storytelling techniques, financial storytelling techniques. By the way, I teach the financial storytelling as well, how the finance story should be communicated towards you. You look towards a balance sheet and the development of these things. Very well development. Now just see the depreciations, how the very well communicated, your capex being presented separately, depreciations on existing assets, depreciations on a current assets, newly purchased assets, and the total depreciation. Here you see depreciation calculation of way better presentations, investment plans, your written down values, your monthly written down values. You got to see depreciation monthly, asset wise, your depreciation allocation, and thus it's very informative for you. You see selling and distribution expenses. Here you got an admin expenses relating your working capital, fixed cost development. Now you see how these things gonna relate your working and how you looked. Here you got to see the financial things. Now you see the fuel working. Total fuel cost, how it is being allocated towards your electricity, steam cost, gas cost, diesel, LPG cost. As a company, it doesn't look toward LPG, but presenting the LPG was very important. Now you see further development of a diesel, growth in a diesel way, your gas development. It is very important to see each line item very deeply. The company doesn't provide the complete information. You need to understand the thing that gas rates should come from Sweet Northern Gas or Sweet Southern Gas. Go to their website, find a rate, confirm to the management, and then input it. Similar way you go toward the stream, similar way you go toward electricity development, your workings, and how these things gonna relate. Your production capacity, how your production capacity relates toward your 12-month development, you need to understand that as well. I hope you understand the things and how the things are gonna be moving in your course and how you relate the things. If you have any question, you can ask me. This is what the Excel DADA firm framework explains, that your financial model should be dynamic, all right. Should be accurate, all right. It should be understandable, presentable. We understand it, and it should be dynamic working. If you have any question, you can ask me. You got a comprehensive overview of a financial model. You understand the things, how you develop things. In the next session, we're gonna work starting on a financial planning analysis, and we're gonna look some development of a financial model. Very first thing, we have a development of a financial model income statement, making in an Excel that relates my EBITDA, my EVA, economic value addition, and the residual income comparison, a complete income statement and its related model. I hope you understand the things very deeply. And how was the session? Just type it, comment, and then we're gonna complete our working. Yes, there is a list of a checklist that you should be needed for understanding the things, the important key notings, all things would be communicated to you onto the classroom as well as your WhatsApp group. That would be very helpful for all of you. A list has already been prepared, only being shared to you. Step by step approach is being used for the development of a financial model. So, how was the session by Mr. Bilal, Mr. Omer, and some other participants? And if I miss some questions, you can ask me again. I'll be happy to answer you. The session was very informative and knowledgeable. Thank you, Mr. Bilal, and I hope you understand the session. And if someone is not being registered for FMVA, I hope after this session all your queries, ambiguities would be answerable and do connect it for the further registration of a session. Yes, we are Asians. I can teach you in Urdu as well. By the way, I choose an English language because everyone is working professional. I hope they understand an English language. That's why I only use. There was no specific requirement to use an English language. Mr. Omer, the session was excellent, knowledgeable, and lot of things got clear. Thank you very much. There's been azan now time. Yes, Mr. Wasim. Uh, we gonna see many more things. We have a hands-on exercises for financial model development, three statement model, income statement development, free cash flow development, discounted cash flows. I told you that the very first case study of EBITDA versus EVA versus RI and some further KPI development. Yes, I would be also telling you or sharing you the list of a KPIs for merger and acquisitions as well, and how we evaluate any financial health of a company. I will be teaching you that as well. Basically, it's being a part of a financial analysis, but sometimes you look many different things. As I showed you an income statement that includes a no pat margin as well. That is a new thing. Yes, Mr. Mayor, I hope you understand all things, and I hope I address your queries very importantly according to your requirements. It's my suggestion if you share any education related material that we'll be teaching in the next session. So uh, we will be go through it before the session start, so that during the session we know the background of the things when you will be explaining. Yes, I will be sharing the things in the WhatsApp group, not in the WhatsApp group, on the Google Classroom. The you will be having an access of it on a Google Classroom. Just type Mr. Bilal if you have already been added into the WhatsApp group. I'll be making Google Classroom access in just a while, and that will be shared to you. All the participants in a live session just type that are you added into the WhatsApp group and pay the respective fees. Thus, we can further communicate onto the Google Classroom for the lecture. This lecture would also be added onto the YouTube as well as your Google Classroom. Yes, thank you very much, Mr. Bilal. You are being added. Now, I have a question from Mr. Wasim as well. If he's being in a call, that is he being added there? Yes, I am in a WhatsApp group. Very good, Mr. Wasim. You are also being added. Now, just I'll be closing the session. If you have any question, you can ask me. I hope you liked the session very much. It was very informative. And in the next, by the way, in the next Sunday, I'm going to start a new batch on a Power BI for a finance professional. That is also being a comprehensive training. Mr. Wasim, you have an option. I'll be sharing the link of its orientation onto the group as well for all of you to join to that introductory session. Do we require any Power BI software? Yes. If you want to work on a Power BI to learn it, to get an hands-on experience, you need to download a Power BI. That's absolutely free software. Microsoft doesn't charge anything. Only need to search on a Microsoft Store or a website that download Microsoft Power BI desktop. Download it. It is very informative session mode. Yes, I will be sharing the link on the WhatsApp group as well. No issues, Mr. Bilal. It's your thank you. Uh, Yes, for the Power BI training, there is a separate cost for it, but the introductory class would be free for the registered participant. Don't worry, you would be learning into the introductory class as well. And remember, thing, just I'll be sharing anything for you. Just view my screen. If you see the screen analysis of an income statement, just wait. Now you see here. You got to see analysis of income statement. This income statement is being developed on a Power BI tool. I developed this income statement analysis on a Power BI, and today it's being a second session on an income statement analysis. I will be completing this table along some further KPIs as well. Thank you very much for joining the session. I'll be closing my session. Allah Hafiz.